you get a little wiggle on the downside in the stock market. And there is a tremendous myopic tendency for so many people to say, is this the start of a bear market? And in reality, it could be, or it could be the beginning of a correction. But the two are fundamentally very different. And they're different in these ways. When you have a correction, there's always one or more really scary stories that tend to dominate attention. And those one or two are parallel to a stock market that goes down steep and fast. Not as big as what happened in February, March of 2020, but fast. 1, 2, 3 months to go down as much as 20% in global stocks. Broad market, global stocks, something that drops 10 to 20. The nature of it is it's fast, it's sharp, and it's largely one way. It also, oh, by the way, tends to correct in a V-shaped pattern that bounces back just about exactly as fast as it went down. Bear markets, by conventional standards, take a long time, a year to two. They're down more than 20%, but they start off gently. One of my rules that is just basic, I've done this right, I've done this wrong, but the rules always worked, is the first 3 months of a real bear market, a conventional bear market, tend to be relatively gentle. And the totality of the bear market, from its absolute peak to its absolute bottom, tends to average 2 to 3% per month. It vacillates around that, of course, but averages from top to bottom about 2 to 3% per month. The back 2/3 in magnitude of the drop, not this, but this. The back 2/3 of the drop in magnitude tends to only be the last 1/3 approximately of time. And the first 2/3 of time, from the top to the bottom, that first 2/3 of time tends to only be about 1/3 of the drop. And in that early gentle phase, after the bull markets rolled over and started to go down, what you hear people say all the time is, I didn't get in enough before. This is my opportunity to get in. And this is, in a sense, the great humiliator of the stock market, hornswaggling the last greater fool to get into stocks before you get to that last 2/3 that go, Wah! The point that I'm wanting you to see, said simply, is corrections tend to be short and sharp, come out of nowhere, and end about as fast as they came, reversing in a near V-shaped pattern. The conventional real bear market tends to be slow and gentle starting. I've always said there's not much lost in the first 3 months. So I never would turn bearish. And I have turned bearish successfully sometimes in my life, and I've missed it sometimes. But I would never turn bearish until I'd seen higher prices 3 months earlier, because it's always easier to tell what's happened after you have more evidence, and to actually see a bear market peak after it's occurred than before. The history of the stock market is like it's like a cemetery with graves littered of people who've tried to foretell a bear market beginning and a bull market peak before it happened. The fact is, no one can call correction successfully on any consistent basis. No one ever has. No one's ever gotten rich calling corrections. It's not even worth trying to sidestep them because they're so short and sharp and come out of nowhere and reverse so fast. They happen for any reason or no reason at any point in time. And you can have a couple in a year, or you can go years and years without having one. They, on average, have been about one a year, but there's no way to know in the next year or two if there'd be any. Or there could be a couple in a year. But bear markets are worth, if you can, trying to sidestep a piece out of them because they're bigger. It's a fundamentally different thing, and they act different. And understanding the difference in how they act is important in understanding what you should do relative to whether you should take action or try to take action or even think about taking action or not. You think about it if you think it's really a bear market that's already underway, and you've waited the 3 months after, and you can see big fundamental negatives that aren't already widely pre-priced. If it's just that short, sharp thing that's a correction, you just ride it out because it doesn't take very long to get past it. And if you try to play a correction, as so many have so often, you tend to get whipsawed. You tend to get out too low and get back in at higher prices and have lost for the activity. Thank you very much for listening to me.
Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.